Hi, my name is David Lincoln, and you're watching the Short Vol Show on YouTube. And wow, amazing! Let me get my cowboy hat on. Yippee-yi-yay! Yippee-ki-yay! We have 15% Contango, folks. Do you know what that means? That means this stuff is decaying like crazy, and I hope that you have been following this channel and taking my suggestions to short volatility because it's been an amazing ride so far. This last week, if we look at the sample position here, we switched to we put a spread on a few days ago where we bought the November 24-28 put spread. We paid $231. So we invested a little under $5,000 on that trade, and we are up $1,300 in less than a week on that one. So the P&L, let's see. P&L is looking fabulous today, folks, as we hold the position short 261 deltas, and UVXY down another day in a row. An amazing run for UVXY to the downside as the positions continue to make money. I wake up every morning and we've made more money. It's so easy. Trading is so easy. It takes nothing. What do? You just set it and forget it. So easy out there. It's just every day you make money in trading, and then you just retire. It's so easy. No, I'm being facetious. Of course, trading is very difficult, and this brief, nice run that we've had, short volatility, is a beautiful thing, but we know that these things don't last forever, and we have to be careful, and we have to figure out where we're going to cover this position here, because the VIX is not going to go down forever. VIX currently 1364 with 15% Contango. Now, 15% Contango means that UVXY, if the VIX just stays where it is, UVXY is decaying by about $3 per month. So this thing is really just melting before our eyes right now. And if we stay there, it will continue to melt. Now, I want to show you a chart which we haven't looked at in a few sessions here, but I always find it interesting, and I hope you will too. So let's go to the chart here. This is on VIX Central, and it's a historical Contango chart. So if I get my silly-looking cowboy hat and mug out of the way here, we can check this out. Okay, so on VIX Central, we can go to Contango. It's the Contango tab up here. And what I like to do is I highlight just 2019. So I go to 2019, I press down on my left mouse button, and I pull it across. So we just have 2019. Okay, and then I unclick F4 to F7 Contango because we just want front month Contango. That's what's affecting VIX ETPs. And when we look here, everything above the red line is we're in Contango and we're at like maximum decay. Now below the red line, we're in backwardation. You can still get some decay from just the fact that this is a leveraged ETF and you get some of that sort of beta drift type decay. But above the red line is when we actually have the most edge to the downside. That's when we're in Contango. And you can see we've spent, which is typical in this period. This is just, this is about a year period. So, and you can see the first part of that year period, we were in backwardation. It was a rocky time at the end of last year. But then you can see from like January on, we've been in Contango almost the whole time, besides that little blip about a month ago. That was the blip that got UVXY back up to 40. But now you can see this line is just reaching to the sky. And we know, if you look at the past, that it's not going to stay up there. It's going to come back down, but we might go for a little ride. You can see how this period here, it's like a couple months where we're in Contango and we're in decent Contango. So we're back in that stage now. It might stay here for a couple months. It might stay here for 1 minute and go straight down. We don't know what's going to happen, but typically speaking, we've entered a range of like big Contango, and we'll probably stay there for a little bit at least. Look, we got up to 18% here, and as my buddy Brent will point out to you, this Contango number of 13.69%, just because that's today doesn't mean that the actual index that this is based on is going to stay decaying 13%. We're dealing with averages over time, but when you have a daily Contango, that's just going to slightly raise the average of how much this is decaying. So this is a really cool thing for us. However, there's two ways of looking at, if we go back actually just to these term structure, there's two ways of looking at the term structure. One is that, oh, it's great that we're in Contango, but the other is that the front month futures are low, but the months after that are a lot higher than now. So what this one way of interpreting this chart here would be to say, well, we're expecting volatility to be higher in October than it is now, which would say we're coming probably into higher volatility times in the next month or two. And that would make sense that we get back up to 16%. I mean, we haven't dipped below 14 or 15% in a while now, and it could seem completely reasonable that, with rate cut fears and uncertainty and all the other stuff that has been plaguing the market in the last few months, that we could get back up to 16% in a month or two. And every time we get to this beautiful Contango of like 15%, it seems like it never lasts for very long. Let's take a look at the chart of UVXY here for a second. And we can see that indeed, you can see the down move here, okay? So really, really whippy through August. We know we had several peaks and valleys in August where stuff's whipping around. And then just this down move into the beginning of September. It's just been an extended down move. Now, I came on around the 9th here, and I said to you, I know it's down, but this might not be a point to actually start buying volatility. Say, oh, well, it got to 28, so I'm going to buy it. I came on and said, not necessarily. And I also mentioned that I like to either be flat this or short it, and I'm never in a buying mood because we know that it's going to continue lower over time. And the reason I'm never a buyer of this is because I did, earlier on, try to buy this, and I just got burned and burned and burned. And, a similar thing to buying this, which would be to sell puts, I tried to do that earlier on in my VIX career, and I just got burned and burned and burned. So if we were to look here, for example, at next week puts, let's take a look at the 20 September options markets in UVXY right now on the screen, and I'll tell you what I mean. All right, so look here, it said the 23 puts are trading 40 cents, and it seems like, wow, this hasn't been to 23 in a long time, and that would be breaking the all-time low next week. I'm going to sell some of these puts for 40 cents. But the thing is that I've done this before and just gotten burned. First of all, you're not making that much money. You make, $40 to sell one of these puts if you're lucky, and everything goes right. If it gaps up, all right, you made $40, big deal. But you could easily get run over, and these easily could end up being $1.40 before you know it. So not a great trade for me selling these 23 puts. I have considered, so our delta right now is short 262. I have considered buying some out of the money call spreads. You could buy like the 26, 28 call spread here. Let's cue that up. And you could pay 37 cents for something that's potentially worth $4. And that's kind of like a long shot trade, though. To me, that's kind of like buying a scratch ticket, Yeah, it could come in, you could make big, but also nothing could happen, or this thing could just go up to 26 and just stay there, and then you think you're going to make money, but you don't. So that's not a great trade either. But let's talk about what we could do to actually hedge this 28-24 put spread that we're long. And then I want to get on to some of the media that's come out in the last couple of days, because you and I, as people that know something about the VIX, would think that some of this media that's come out recently is just garbage. My mom could have written my mom is, knows very little about the markets. She's in her 70s, and she could have written these articles. She knows more about the VIX, or enough about the VIX to have written some of these articles that come out. These guys make these big, things that say, wow, it's this big, nice flowery language to describe that hey, there's something called Contango, and it makes VIX ETPs go down. So you might want to consider shorting them because this thing called Contango, well, we're in it more than half the time, and it makes them go lower. And if you look at the chart of UVXY, it seems to be going down. It's like, wow, you're getting paid by Seeking Alpha to make an article like that? And they mention, and there's another guy who comes in, he's like, when the term structure is in Contango, that's like the normal state of the market when the market's rallying. When the term structure is in backwardation, something's wrong, and you should sell. You should sell out of your long positions and get short. Kind of, this guy kind of comes in and says like the term structure can predict what the market's going to do, which is highly inferred in this article, but it's not true. The term structure doesn't infer anything. Yes, when the market's selling off, we get into backwardation, and when people are afraid, the VIX spikes and we go into backwardation. But that doesn't predict anything. It just happens when the market sells off. It's not like we go into backwardation first and then the market sells off after. You have time. It's not like we have time. You have time to like jump and sell stuff after we go into backwardation. The term structure is not predictive. You hear me saying that almost every day. This article tries to suggest that it is. And once again, these guys use flowery language. They're like, oh, we were sitting around the table and we actually started talking about the VIX. Like they're really sophisticated, that they're playing like three-dimensional chess, and they've gone to the next level with their investments because they're talking about the VIX. To you and I, we know what the VIX is. We know that the VIX represents a it's made up from a strip of options on the SPX, and when fund managers get afraid, they buy puts in the SPX, and when they buy puts, the VIX goes higher. Additionally, more sophisticated fund managers might buy VIX calls, VIX call options in VIX futures. That makes the VVIX go up because when they buy these call options in the futures, VVIX is a measure of volatility of the VIX futures, and VVIX goes up. But just to say that, like, to try to act like we're real sophisticated because we saw we looked at the VIX, and then this guy was saying, we were sitting around the table, and my friends back when the VIX was 10 were saying, maybe it's not going to stay at 10, and they turned out to be right. It didn't stay at 10. Well, everybody and their mom, when it was at 10, were saying it's not going to stay at 10, and of course, that's the all-time low of 8. I think it was like 858 maybe. Of course, when it's at the all-time low, people are saying it's going to go higher. That's not exactly, something that Seeking Alpha should pay you to say. Additionally, to say that, well, since Volmageddon, the VIX has been higher and it's a new environment, that's not a great revelation either to anybody except somebody who's never heard of the VIX before. We all know that the collapse of XIV and the Volmageddon whipped stuff around, and since then, there's been less liquidity. There's been less paper, to be honest with you, less players in this market. But also, there's been, stuff is not as wound up as it was back then. It was more dangerous back then than it is now. Maybe volatility has been slightly higher now, but there was a big spring that was pushed, and was ready to pop and explode. And that pressure cooker is gone now. As much as we complain about UVXY being nerfed, and Michael Listman made a good point on Twitter the other day that SVXY was nerfed a lot worse even than UVXY. SVXY went from 2 times to half. UVXY went from 2 times to 1.5 times. Imagine if they'd nerfed UVXY from 2 times leverage to 0.5 times leverage. That's what happened to SVXY. So a lot of these products, the ability for the general public to very easily make a leverage bet and volatility disappear. Now, more sophisticated people can make a leverage bet and volatility using options very easily. And frankly, we always could before the advent of ETPs. However, the ability of just like random Joe retail to jump in there and put margin money in a leverage short volatility ETP is gone, and this leads to although vol levels have been higher, this leads to a slightly less dangerous market and less of a chance of stuff going really, really wrong, in my opinion. In the end, there's only so many people out there. There's a certain amount of liquidity of people who are willing to take risk, and when you've got risk in the markets, you can lay it off, and there's a limited amount of people who you can lay off your risk to, whether it comes in the form of VIX stuff or options on the SPX put sellers. That liquidity pool, in the end, is a limited amount of people, and how much liquidity there is there. I think in a way, VIX ETPs and giving the public access to spreading that risk to them a little bit isn't necessarily a bad thing. The more liquidity there is, and the more people that you can spread risk out to, the more dynamic of a system you have, in my opinion. So that's an argument for why this like pattern day trading rule should not exist. People misunderstand. They think, oh, well, day traders and people playing the market is a bad thing for the markets, but it's actually not. It actually absorbs shock. The more people you have, the wider you spread risk out, the more it's able to be absorbed by, when something actually does happen. So I'll get back to these specific articles in a second, because I think that they're ridiculous and they're not really telling very much. But maybe that's just because my viewers here are more sophisticated than that. Maybe that's just for people who know nothing about the VIX. But we'll get onto them specifically for a second. But let's go back just for a second to how should we hedge the position we have on now. And I haven't really hedged it at all. I've just left it because too many times I feel when I've had a winning position, I immediately take the profits. And I don't want to be a person who, lets the losers run and the profits get cut off right away. So just been riding this for the last couple of days, and it certainly has worked out, but it's not going to work out forever. However, with 60 days to go, let's see how many days left we have till expiration. So there's 63 days left till November expiration. This position does the best if we're below 24. Now we're around 24.73. So let's say we open the position today. It seems reasonable to bet that in 63 days UVXY will be 24 or below, because once again 15% Contango means that every month this is decaying by $3 right now. So if we're around 24.75 right now, if the VIX stays here 2 months from now, this should decay by, let's say, $5, because we're not dealing with a $30 thing anymore. We're dealing with a $25 thing. So let's say that the decay is somewhere around $5 for 2 months here. So $5. So if the VIX is right here, this will be $5 lower. This will be trading 20 at the end of November. If the VIX pops by a couple points, this could still be 24 or below. Now, if we can take this position off for a very good profit, at some point we will. But the other thing I want to throw out there, and tell me what you think of this, is turning this position, and you've seen me do this before, turning this long put spread into a condor. So the way we would do that is, instead of selling out the put spread, right now I was looking earlier today, the midpoint of the 24.28 put vertical. And some people ask me in the comments, well, why don't I just buy puts in here? And longer term viewers of the show will know the answer to that. Buying puts in here, a lot of times what happens is you just run out of time. And if you own a put, it decays a lot on you. So if I was just long, let's say I spent $5,000 on this trade. If I had spent $5,000 just on November 28 puts, I would have been able to buy like 8 or 9 of them, right? So let's model that for a second, just long 8 puts. So November 28 puts, analyze tab, I'm going to buy them. So if we had just bought November 28 puts, I'm going to put in 8, since 6 times 8 is 48, so they were probably a little cheaper at the time, but this would give us a delta down here of short 400. Up there we're short 345, but it's costing us $26 a day, right? So yeah, any short position would have made money in this big down move we've had. However, if we just sat for a while, this starts, that 26 a day starts to kind of weigh on you after a while. The spread we had on is showing us the decay of $10 a day. And lots of times you buy puts, and the other thing with just buying straight out puts is, as you'll notice, unlike stocks, as UVXY goes lower, volatility comes in. So right now we're showing in the front months on the chart we're in the low 90s, I believe. So we're showing, so front we're showing 92 for 20 SEP expiration and 96 for 27 SEP. However, we've come in a lot. When we were considering buying this put spread, that was well over 100. And so you could find yourself in the situation where you buy these NOV 28 puts, and this goes down a couple bucks, and the puts don't move, or they heavily underperform. With a put spread, you've got one long and one short option. Whichever strike you're closest to is the one that the theta affects the most. So, when we were before closer to the 28 strike, we had more decay issues. As, we hopefully blow through the 24 strike and we're below the 24 strike, then we're collecting decay every day on this spread. So decay, time is very important. It's one of the hardest things about trading in general, but position trading and position trading the VIX specifically, is that this is a long-term proposition. It plays out over days and weeks, and it can be very difficult when you're a new trader to, you're in the moment. Today's a Friday. You want to make money today. You want to put stuff on, take it off, and to kind of get into the flow of the fact, like, well, this is a several-month proposition. This UVXY it was setting up for a lot of August. It was up, up, up. And we were kind of waiting to put a position on, because the VIX was up, up, up. Then finally, you do put a position on. The VIX slowly starts moving downward, and it slowly gains momentum. But this is something that happens over a period of time, and thus you need to consider how your position is being affected over time. Are you putting time on your side by collecting money? Is the clock ticking for you? If I were to buy a spread that was expiring with less time for it, I might be able to turn the limited capital I have into more short deltas if I move forward in time, so there are only like a few days till expiration. However, the less time you have on your side, especially trading a VIX ETP, the more risk you have, because you never know when you're going to get a little spike that lasts a day or two and then stuff goes back down. You get that big spike maybe once a year that can last, a month or two. We had a spike last year that lasted like 6 months. So you need to try to put time on your side with these things, and thus buying outright puts. You might say, $25 a day decay, that's nothing. But then, you get a long weekend, a couple long weekends. There's a 3-day weekend, you're losing 75. Then you get a mini spike that lasts a few days. Okay, then it turns into a couple $100. And pretty soon you're like, I need to roll these puts but out farther, and it can be a nightmare. So I try to limit my decay as much as possible. Another way of saying that is lowering your cost basis. So let's get back to, we've got this 24-28 put spread. How do we want to hedge it? I was suggesting to you that it would be nice to put some sort of condor on, because then you you could potentially make all of that money when the 24-28 put spread goes out for $4. That's the distance between strikes, plus even more money from selling out of the money put spread that goes out worthless. So ideally, we paid $230 for the spread. If we could sell another spread for at $230, then if we could sell another $4 spread at $230, then essentially we've taken in over $4 for a $4 spread. So if we're selling, if we're synthetically selling a $4 spread for more than $4, then that's great. But let's be more realistic here. So I was looking at, so we have the 28-24 put spread. I was thinking I could sell something like the 20 and then pick $4 below that 16 put spread. Right now, that's trading at around $1.21. And, if we were able to sell a $4 put spread for $1.21 and, 20 times, we have the spread on 21 times. If we were able to sell the other spread 20 times, that would be an extra, and UVXY went out somewhere between 20 and 24. That would be an extra $2,500 that we made on the trade. So the original trade we had was done 20 times. It was the 28-24 put spread. So what's the maximum we can make on that? Well, it's 20 times $4, which is $8,000. If we are able to sell out of the money puts somewhere down here against that, then we can actually make more income if the spread ultimately ends up in between the strike. So if we were able to sell, like for example, if I was to sell the 19 put and buy the 15 put, then we would have between 19 and 24 is our bullseye to, and if it ended up there in 63 days, we would make an additional, let's see, 19, if you sell the 19 put and you buy the 15 put, 79 cents. So 80 cents. So you get an additional $1,600 if it ended up in the middle. The other point of selling this put spread down below here or turning this into a condor is just to lock in some of your gains, because when we sell a put spread, that's going to affect our delta and it's going to lessen it. So for example, if I sell this, let's take a more reasonable spread, the 21-17 spread, okay. If I sell this for $1.74 20 times, the initial spread was 21. So if I sell this spread 21 times, then it is going to affect my delta in that now my delta is actually long delta. So I turned it into, from being short 259 deltas, all of a sudden I'm long 80 deltas, and I'm collecting $20 a day. So it would be great to do the spread, and then if the thing, for heaven forbid, this thing actually spikes from here, bad news comes out tomorrow and this spikes. Well, you've all of a sudden sold this spread for over $3,000 against it, and that's $3,000 that you're not going to lose. So you've locked in, and then if this spikes back to 27, up 10%, you're actually making money. So there's certainly reason to either hedge or lock in some deltas on the gain here. Now, what am I actually going to do? Probably nothing. I'm just considering just leaving this for another day or two and seeing if we can't squeeze a little bit more out of it. We did lose money when this went up, when on the spikes here. So it's nice to make it on the way down. And who am I to say that this is the bottom here and that we should call the bottom right here? Maybe I will do something to take off the delta a little bit, maybe sell out a couple spreads. I do like the idea of selling something, though, that's not actually selling out the 28-24, actually just selling a put spread below it a little bit. You can kind of trade that. You could sell a few put spreads below it, and then if we get a little bit of rally in UVXY, then you could buy those back in for a better price just to kind of trade around part of the position. But let's look at the articles I was talking about really quickly. I know I've gone a little bit long here, so let's do this really quickly. So if we do VIX seeking alpha in our browser, we get the Brave post 2017 world of VIX. What a timely article, 2 years later. All right, so I think this article doesn't really say anything that we don't already know. It basically says that vol was low there, and it basically says volatility could stay really high for the rest of this year. And he's saying, well, if it goes to 10, it's definitely going to go higher than that. He says, every time the VIX index falls to the 11 to 14 range, it should serve as an indicator that a spike is just around the corner. If VIX proceeds to fall below 10, then a meltdown is coming. It's kind of counterintuitive because if volatility is really low, well, I mean, if volatility is really low, then it is going to go higher from there because it can't go any lower than the lowest it is, right? So it doesn't seem to be saying a whole lot of stuff. It says VXX short-term futures ETN. As we look towards the end of the year, we believe that a replay of last year's fourth quarter could definitely be in store. And he's saying if VIX gets to 11, that it's a buy. That doesn't seem like a huge revelation. I think everybody would agree that. Let's take a look at the chart of the VIX. So what he's saying, what this gentleman is saying, and no disrespect to the gentleman. What this gentleman is saying is that here's the VIX. Let's go to a 3-year chart. He's saying if the VIX gets down to like this level, then it's probably a buy, way below where it is now. I think 99.9% of the public, including my mom, would agree with that statement. So thank you for the amazing revelation. Pay this man on Seeking Alpha for his amazing insights. Okay, and then let's look at this other one here. VIXY, short the Contango roll in VIX futures. Wow, sounds complicated. VIXY tracks an index which maintains constant exposure in the front 2 months of VIX futures contracts, as does VXX, as does UEXY, as does SVXY. In this article, I make the case that the long-term trend of VIXY remains intact and that investors should consider shorting this instrument. So what you're saying is that VIX ETPs are not going to turn around and go up after going down forever? Mathematically, it's impossible for this to go up. So saying that it's going to go down doesn't seem like much of a revelation. So you're saying that this particular VIX ETP is probably going to go down? Give this man money, pay this man Seeking Alpha. He's definitely earned his money on Seeking Alpha today. That's an amazing revelation. Unbelievable. Wow. When I write about ETFs and ETNs, one of the first things I do is dig into the mechanics. In the case of VIXY, it's fairly straightforward implementation of the S&P 500 short-term futures index, VIX futures index. It follows a methodology. And he's got methodology with a link so that you can click that and it will give an explanation of what methodology is. Oh, no, it doesn't. It goes to the ProShares website. Sorry about that. The S&P VIX short-term futures index provides a constant exposure. SP Vixter. SIBO futures. There's something called the roll yield. Since futures priced in later months tend to approach the front of the curve as time approaches expiry, the structure of the market is very important for understanding roll yield. Here's the current term structure. When the market is in contango, it means that which it means that the strategy which VIXI follows is currently losing money due to a negative roll yield. It's currently losing money due to the fact that the futures are falling, not because of the roll yield. But anyways, these things, people get confused. They think that like somehow when you when these are rebalanced, you like lose money somehow. Well, no, the problem is that the futures are always falling towards spot. Okay, when you rebalance, you just move up a little bit to the next future that's a little bit higher up and has more room to fall. But the way it's actually losing money is futures are falling. Now, I'm not saying that this guy is misunderstanding that particular concept. I'm just re-explaining that to you. But this guy is basically saying that the S&P is going up and the VIX is going down. So basically he's saying that there's a thing called Contango and it makes these VIX ETPs go down. And so you should probably sell it because we're mostly in Contango. Now, once again, my mom knows this stuff. My mom could have written this article. So thank you. That's amazing revelations. Pay this man for seeking alpha. It just, the only good guy on here is my buddy. Let's go VIX seeking alpha. The only VIX guy you want to watch on seeking alpha is my buddy right here, balance the trade. He's giving specific catalysts for why stuff is moving around, and he follows all these guys on Twitter, and he gives updates from Twitter. There's a term structure. He's talking about volatility on the bonds and a much more sophisticated guide to check out. Very cool. And I have to log in to like that article. Here we go. TVIX, stay short volatility. Now this is by one of the same guy from before. Okay. Anyway, so I'm not impressed with seeking alpha and all the articles on the VIX lately. It's either really basic stuff that you guys already know. I guess it's not intended for people like us. It's intended for people who know nothing about the stock market, I guess. It's just kind of disappointing. Anyway, all right. So awesome. Yeehaw. Great moves in the VIX. Our stock AIMT is halted as awaiting news. The conference is going on today. They've halted the stock. We'll have to see what happens. It looks bullish. We'll have to see. I hope those guys make money. All those guys on StockTwits are long, so hopefully it goes up for them and they make money. I have no position. I did have a position in ACB for earnings, and I bought around 6 and also 634 or something. It's down like 50 cents from where I bought it after earnings, which isn't a terrible result. I think we'll see this slowly inch higher from where we are. My reasoning for buying this ahead of earnings was I just felt like that it really had a floor around $5, and it wasn't really going to go below there. So I figured just there was more upside than downside, and that earnings seems to have borne that out. Earnings was slightly disappointing. In this day and age when there's so much guidance from companies, earnings seems less important sometimes because everybody is more transparent than they used to be. However, with all the transparency these guys had, they still missed. So not a great result for earnings. I know it's a tough business, the MJ business, and everybody wants to make money. It's just great cocktail conversation to be able to say, "Oh, I made money in an MJ stock," and everybody wants to make money in these, but it's very hard to do so. It turns out. So there you have it going into the weekend. UVXY a little off the lows right here, hanging around 25. And I'm thinking about going on Twitch. Do you guys want to see me live on Twitch? I miss the live interaction. I want to get live feedback from you guys. I don't like this ban on me live streaming YouTube, and I'm trying to appeal it without upsetting them too much and having them like put an actual strike against me. But in the meantime, I'm probably going to go on Twitch starting next week because I like the live interaction with you guys. Thanks for watching. Have a great weekend. I hope that you are short volatility as I have been and have made some money. Good luck moving forward. Keep the questions coming. I know there's a lot of new people out there who probably don't know half of what I'm talking about. And for you, please ask your questions and I'll try to answer them as best I can. I really appreciate you watching, even if you're new to the VIX. We can all learn together. There's certain things I know about, but most things in the world I know nothing about. So let's teach each other. Thanks for watching. We'll see you soon.